Welcome to Solidarity Spotlight, the place where we share with you bleeding-edge stories. I'm your host, Solidarity. Let's discover what's happening today in blockchain. The cryptocurrency landscape continues to evolve at breakneck speed, with today bringing a confluence of developments that paint a picture of an industry at a critical juncture. The overall market sentiment appears to be one of cautious optimism, with Bitcoin maintaining its position above the psychologically important $110,000 threshold, while the broader crypto market capitalization hovers around the $3.8 trillion mark. This consolidation phase, while seemingly stagnant to casual observers, often precedes significant breakouts in either direction, making the current period particularly fascinating for market watchers. The altcoin ecosystem is showing particularly intriguing signs of life, with the altcoin season index climbing to 55, representing a notable increase from last month's reading of 39. This shift suggests that capital is beginning to rotate away from Bitcoin dominance toward alternative cryptocurrencies, a pattern that historically correlates with broader market expansion phases. The implications of this rotation could be substantial, as altcoin seasons typically coincide with increased retail participation and heightened speculation across the entire cryptocurrency spectrum. Market participants are closely monitoring this metric as it could signal the beginning of a sustained rally in smaller cap digital assets. Among the standout performers in the alternative cryptocurrency space, several projects are garnering significant attention due to their fundamental developments and market positioning. Chainlink continues to solidify its position as the premier Oracle solution in the blockchain ecosystem, with its infrastructure becoming increasingly critical as the tokenization of real-world assets gains momentum. The growing adoption of hybrid finance solutions and the expansion of decentralized finance applications that require reliable data feeds positions Chainlink as a potential beneficiary of the broader blockchain adoption curve. The market impact of Chainlink's continued integration across multiple blockchain networks could be substantial, particularly as institutional players seek reliable infrastructure for their digital asset operations. Similarly, Ethena has emerged as a significant player in the synthetic stablecoin and yield-bearing sector, attracting substantial institutional backing with a remarkable $890 million funding round. This massive capital injection, which includes a $530 million PIP deal, led by prominent firms like Brevan Howard and Susquehanna, signals strong institutional confidence in the protocol's approach to algorithmic stablecoins. The funding will enable the merged entity, StablecoinX Inc., to hold over 3 billion ENA tokens and pursue a potential NASDAQ listing under the ticker USDE by late 2025. The market implications of this development extend beyond just Ethena, as it demonstrates the growing appetite for compliant yield-bearing products in an environment where traditional stablecoin yields face increasing regulatory scrutiny. The regulatory landscape itself is undergoing dramatic transformation, with the United States Securities and Exchange Commission launching Project Crypto, a comprehensive initiative aimed at modernizing securities laws to foster capital formation in digital asset markets. This represents a stark departure from the previous administration's approach of regulation through enforcement, signaling a new era of regulatory clarity that could unlock significant institutional capital currently sitting on the sidelines. The project's stated goal of enabling America's financial markets to move on-chain suggests a fundamental shift in how regulators view blockchain technology's role in traditional finance. This regulatory evolution is occurring alongside similar developments globally, with the European Union's markets in crypto assets regulation fully operational since January 2025, providing a harmonized framework across European markets. The convergence of regulatory clarity in major jurisdictions is creating an environment where institutional adoption can accelerate without the previous concerns about compliance uncertainty. The market impact of this regulatory alignment could be transformative, as it removes one of the primary barriers that has historically prevented large-scale institutional participation in digital asset markets. Speaking of institutional adoption, recent survey data reveals that 59% of institutional investors plan to allocate over 5% of their assets under management to cryptocurrencies in 2025, representing a significant increase in institutional commitment to the asset class. This growing institutional interest is not limited to simple buy and hold strategies, as 24% of institutional investors currently engage in decentralized finance activities. With this figure projected to triple to 74% within 2 years. The implications of this institutional embrace of DeFi protocols could be profound, bringing sophisticated capital and risk management practices to previously retail-dominated markets, while simultaneously driving innovation in institutional-grade DeFi products. The decentralized finance sector itself is experiencing both challenges and innovations that highlight the maturation of the ecosystem. The recent Venus Protocol incident, where $13.5 million was initially drained by the notorious Lazarus Group through a phishing attack, ultimately became a landmark moment for DeFi governance, when the community successfully mobilized to freeze the attacker's account and recover essentially all stolen funds within 12 hours. This unprecedented recovery, achieved through rapid governance voting and coordinated community action, demonstrates the evolving sophistication of DeFi protocols in responding to security threats, while simultaneously raising important questions about the balance between security and decentralization principles. The successful recovery at Venus Protocol contrasts sharply with other recent DeFi incidents, such as the $2.3 million hack of the Bunny DEX, which exploited flaws in custom liquidity rewards code and forced the protocol to freeze all smart contracts. These incidents collectively illustrate the ongoing security challenges facing the DeFi ecosystem, while also highlighting the improving response mechanisms and community coordination capabilities that are developing across the space. Infrastructure developments continue to expand the blockchain ecosystem's capabilities, with Aaving, the decentralized finance protocol, managing $70 billion in net deposits, launching on the Aptos blockchain. This expansion represents more than just another deployment, as it brings sophisticated lending and borrowing capabilities to a blockchain ecosystem that previously lacked major DeFi competitors. The arrival of such a significant protocol on Aptos could catalyze broader ecosystem development and increase the blockchain's total value locked, which currently stands at $857 million, compared to protocols like PancakeSwap's $2.1 billion on the platform. The gaming and entertainment sectors within blockchain are also experiencing significant developments, with the emergence of XRPL GameChain, representing XRP's entry into the gaming ecosystem. The B3 gaming platform's expansion from Ethereum's base to the XRP ledger, backed by XRPL Commons, begins with a testnet arcade called Xcade, featuring 5 hyper-casual, mobile-friendly titles designed to onboard new players. This cross-chain expansion of gaming infrastructure suggests a maturing understanding of how different blockchain networks can serve specialized use cases while maintaining interoperability. The intersection of traditional gaming and blockchain technology is further exemplified by Pudgy Penguin's collaboration with Mythical Games to launch Pudgy Party, a Web3 mobile game that subtly integrates blockchain elements through collectible NFT costumes and emotes. The game's approach of making blockchain integration optional rather than mandatory represents an evolution in Web3 gaming design philosophy, prioritizing user experience over technological showcase. Looking toward future challenges and opportunities, the quantum computing threat to blockchain security is becoming increasingly tangible as quantum computers advance from theoretical concepts to practical realities. The potential for quantum algorithms like Shor's algorithm to crack the elliptic curve cryptography that secures most blockchain networks represents a fundamental challenge that the industry must address proactively. Recent analyses suggest that up to 25% of Bitcoin could be at risk if quantum hardware continues advancing without corresponding improvements in cryptographic defenses. However, the industry is not sitting idle in the face of this challenge. The development of quantum-resistant cryptography and the National Institute of Standards and Technology's release of post-quantum cryptography standards provide pathways for blockchain networks to maintain security, even in a quantum computing future. Companies like Quantum Resistant Ledger are actively developing distributed ledger technologies designed to withstand quantum attacks, while quantum random number generators are already being implemented by banks and governments to enhance cryptographic security. The institutional investment landscape continues to evolve rapidly, with traditional financial institutions increasingly recognizing digital assets as legitimate components of diversified portfolios. The transformation in sentiment is perhaps best exemplified by JP Morgan Chase CEO Jamie Dimon's evolution from dismissing Bitcoin as fraud to permitting clients to purchase Bitcoin and reportedly considering offering cryptocurrency-backed loans. This shift reflects broader institutional recognition that digital assets have moved beyond speculative instruments to become potentially valuable portfolio components with unique risk and return characteristics. Web3 development statistics reveal the scale of growth occurring across the blockchain ecosystem, with the total market value reaching approximately $27.5 billion and projections suggesting growth to $81.5 billion by 2030. The integration of artificial intelligence with blockchain technologies is accelerating this growth, with AI-focused crypto projects raising $516 million in funding during the first 8 months of 2025, already exceeding 2024's full-year total by 6%. This convergence of AI and blockchain technologies is creating new use cases and efficiency improvements that could drive the next wave of adoption. The stablecoin market continues to demonstrate its utility in real-world scenarios, with Venezuela providing a compelling case study as stablecoins like USDT increasingly replace the country's bolivar for everyday transactions amid 229% inflation rates. This practical adoption of blockchain-based financial tools in challenging economic environments validates the technology's potential to provide financial stability and access in regions where traditional monetary systems are failing. Central bank digital currencies represent another significant development vector, with 49 pilot projects currently underway worldwide, and 3 countries having fully launched digital currencies. The Federal Reserve's continued exploration of CBDC possibilities, while not committing to implementation, reflects the growing recognition among central banks that digital money infrastructure may become necessary to maintain monetary sovereignty in an increasingly digital financial landscape. The ecosystem expansion continues across multiple dimensions, with Layer 2 scaling solutions gaining significant traction. Coinbase's Layer 2 network, has rapidly ascended to become a top 3 platform for NFT volume within just 30 days, processing $47.7 million in trades, and surpassing established platforms like Solana and Immutable X. This rapid adoption demonstrates the continued importance of scalability solutions in making blockchain technology accessible to mainstream users. Network upgrade roadmaps across major blockchain platforms promise continued technical improvements throughout 2025 and 2026. Ethereum's upcoming Pectra upgrade and Ethereum interoperability layer development aim to enhance Layer 2 application development and enable trust-minimized cross-chain interactions. Similarly, Solana's planned Alpenglow consensus upgrade targets reducing block finality to approximately 150 milliseconds, approaching Web 2 level speeds that could significantly improve user experience for high-frequency applications. The convergence of these developments creates a complex but increasingly mature digital asset ecosystem where regulatory clarity, institutional adoption, technical innovation, and real-world utility are advancing simultaneously. The market implications of this convergence could be substantial, as reduced regulatory uncertainty combines with improved infrastructure and growing institutional participation to create conditions for sustained growth and broader adoption. However, challenges remain significant, particularly around security, scalability, and the looming quantum computing threat. The industry's response to these challenges, including the development of quantum-resistant cryptography, improved DeFi security practices, and continued infrastructure scaling, will likely determine whether the current growth trajectory can be sustained and expanded. The international dimension of blockchain development is also becoming increasingly important, with different jurisdictions taking varied approaches to regulation and adoption. The European Union's comprehensive MiCAR framework contrasts with the United States' more fragmented but increasingly favorable regulatory environment, while countries like those implementing CBDC pilots are exploring sovereign digital currency options. These varied approaches create both opportunities and complexities for global blockchain adoption. That concludes today's Blockchain Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.